Welcome. Subscribe to IAS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Good evening. Please come to IAS 37 Provision, Contingent Liabilities and Contingent Asset. So we have covered the disclosure relating to provisions. Now we'll come to contingent liability definition. There are two definitions of contingent liability. One, a possible obligation that arises from past event and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the enterprise. So in the previous lecture you have learned, for an obligation to be called provision, four conditions are there. There must be present obligation arising out of past event, outflow of resources embodying economic benefit, and a reliable estimate can be made. So in case if all four conditions are satisfied, then it is provision. So suppose this is not satisfied, it is a possible obligation, then you will not call it as a provision. Then it is a contingent liability because it may or may not arise on happening or non-happening of uncertain future event, which is not wholly within the control of the enterprise. So as you know the meaning of possible obligation, the probability of this obligation existing on the reporting date is less than 50%. Okay. Normally in our basic accounting classes, this is a definition that is taught, but there is one more meaning. It is a present obligation. So this condition is satisfied that arises from past event but is not recognized because it is not probable that an outflow of resources embodying economic benefit will be required to settle the obligation. For example, suppose there is a guarantee given by parent company on behalf of subsidiary. Any loss you will incur, we will pay it. So subsidiary will not have to pay anything. So it can disclose it as a contingent liability. And the fourth is a reliable estimate of the amount of obligation cannot be made. So third is a more peculiar situation where you can't make the reliable estimate of the amount. Since you can't make a reliable estimate of the amount, then don't recognize it as a provision. Then what do you do with contingent liability if you don't recognize them? Don't recognize them means you do not show it as a liability in the financial statement. So first let us quickly revise. Contingent liability have following features. It's a possible obligation due to past event, and the obligation on reporting date is not probable. Its existence will be confirmed only by occurrence or non-occurrence of future uncertain event like a court case, and it is not wholly within the control of the enterprise. So this is the explanation of that first definition of contingent liability. Many people think if it is a present obligation, it is a provision. The answer is no. A present obligation would usually give rise to provision, usually, but sometime not, and it is disclosed as a contingent liability. When there is less probability or no probability that outflow of resources will take place, or a reliable estimate cannot be made. Now see the provisions of this chapter related to contingent liability in a summarized form. Contingent liability should not be recognized. Means it won't appear as an obligation or a liability in the financial statement. It should be only disclosed. Contingent liabilities are very important for decision making. If a company has lot of contingent liabilities, that means there is a risk to the investors in future. Okay. So if suppose you are a Vodafone company and you will write that government of India has demanded a tax liability of 10,000 crore rupees. So this is a contingent liability, but in case if the company loses the case, they will have to pay 10,000 crore. So that means your penal account will take a hit in the future, or your cash flow will be there, cash outflow will be there. Sometimes this amount of liability may be so much that in case if it materializes, the company's going concern itself can become doubtful. If you are acquiring a company in a mergers and acquisition deal, then this contingent liability may affect your decision. It may affect the consideration that you have to pay. So that is the importance of contingent liability. Contingent liability will arise also when the entity has jointly and severally given guarantee to a third party. Then you are also liable to pay the amount which the other guarantor has given. A, B, C. A and B has given joint guarantee on behalf of C, 50 crore rupees each. Now what is this arrangement? If C doesn't pay, then A will pay 50 crore, B will pay 50 crore, but the liability is joint also. So if B doesn't pay his share, A will also be required to pay B's share. So what is the total contingent liability A will disclose here? 100. Because in this case, you are also liable to pay if B doesn't pay. Then as a good student of this subject, point number 4 is also useful to you. Contingent liability should be reviewed continuously. Okay. Every reporting date, you see what was my contingent liability disclosed last time. Does it still valid? Is it still valid? Does it still need the same disclosure, or do we need to make some kind of changes in that? Okay. So what are the possible situation in the subsequent reporting date? Contingent liability will remain contingent liability. That means there is no major change in terms of contingent liability. The court case is still hanging for years. It may become provision. It may become provision. Suppose you have lost the court case, or suppose a similar judgment has been passed by the court in another case which is similar to your case, and there the court has given verdict against the company, or not required at all. Suppose you are showing contingent liability, court case, but you have won the court case. Do I need to show contingent liability now? Contingent liability will remain contingent liability, may become provision, neither provision nor contingent liability. Accordingly, on every reporting date, you have to give the treatment of contingent liability. What are the disclosure requirements relating to contingent liability? Where do you give disclosure? Notes. Why you have to give? I have explained. Now, what are the disclosure requirements? A brief description of contingent liability. Estimate of the amount measured as per the recognition criteria for provisions. So, how have you calculated the amount? Follow the same principle which you follow for provision. You have to disclose some amount. That amount will be calculated using same principles which you use for provisions. Then indication of uncertainties relating to outflow. That means if you have any uncertainty relating to outflow, whatever extra information you want to give about outflow, give. You can write there is a 40% probability that we might have to pay. And then you can also disclose the possibility of reimbursement. Your loss may be compensated by somebody else. For example, insurance company, guarantor. Okay. If the above stated items cannot be disclosed, that fact should be disclosed. Now, why the above stated items cannot be disclosed? Sometimes the company may not disclose lot of detail here because the court case is pending. Giving too much information in annual report might work against the company. Okay. So therefore some company says as the matter is in the jurisdiction of the law and we cannot give more information. So only general nature of dispute can be disclosed. Now we'll solve one question. Number 16. During 2004-5, Enterprise A gives a guarantee of certain borrowing of Enterprise B, whose financial condition at that time is sound, good. During 5-6, the financial condition of Enterprise B deteriorates and on 30th September 2005, Enterprise B goes into liquidation. Advise disclosure. First you will answer. On 31st March 2005, what will be the disclosure requirement? On 31st March 2006, what would be the disclosure requirement? (2005) contingent liability, because it's a possible obligation. But in 2006, it has become a present obligation. As the party, that is Enterprise B, his condition has become very bad, goes into liquidation, and therefore you might be called to pay the guaranteed amount. So there is a present obligation, outflow of resources, past event, and a reliable estimate can be made. So in this case, the answer will be on 31st March 2006, a provision would be required. So this way you have to present the answer in the exam. Otherwise you will write A 31st March 5, CL 31st March 2006, provision. That's it. Okay, try one more. Similar problem. Sales tax authority ordered an additional demand on the company for underpayment of sales tax on the basis of under invoicing of goods. So sad. The company contested the case. The lawyer advised the company that as on 31st March 2004, there would be no liability. On 31st March 2005, the lawyer advised the company that on the basis of the latest development in the case, a liability would arise. Okay. So what is the treatment of this sales tax demand on 31st March 4 and 31st March 2005? Similar problem. So on 31st March 2004, you will say there is a there is no present obligation. There is a possible obligation, and therefore the company should not make provision. It should disclose as a contingent liability. For 31st March 2005, now you will say there is a present obligation, and therefore the company should make a provision. One more question. Question number 18. A company has at its financial year ended 31st March 2004 15 lawsuits outstanding, none of which has been settled by the time the accounts are approved by the directors. The directors have estimated that the possible outcomes are as below. So what are the estimation, result, probability, amount of loss? For first 10 cases, the result can be when 0.6, 0 loss with low damages, probability 0.3, loss amount 90,000, but you may lose with high damages, the probability is 0.1, 1,60,000. So this is first 10 cases, this is their estimation. In the next 5 cases, winning probability 0.5, so 0 loss with low damages 0.3, 60,000, loss with high damages 0.2, 95,000. The directors believe that the outcome of each case is independent of the outcome of all the others. Estimate the amount of contingent loss and state the accounting treatment of such contingent loss. Now this question requires you to apply your statistical knowledge. How to compute the estimated loss? A small knowledge of mathematics, brief knowledge of mathematics will be useful. 0.6 into 0, 0.3 into 90,000, expected value formula. 0.1 into 1,60,000. This will give you the amount of loss for one case multiplied by 10 cases. Calculate. How much is that? Final answer 4,30,000. Do the same exercise for next 5 cases. 0.5 into 0 plus 0.3 into 60,000 plus 0.2 into 95,000, and this you multiply by 5. How much is this? 1,85,000. Therefore, total contingent loss 6,15,000. Treatment. Disclose in the notes to accounts. Disclose in the notes. Is it right? Now then, what we have done, we have prepared a small summary. When would a particular obligation be contingent liability? When it would be provision, and when nothing is required. Okay. So check where do you stand. There is a present obligation that probably requires an outflow of resources, and a reliable estimate can be made of the amount of obligation. If this is the situation, provision will be required. All 4 conditions are satisfied. Second column, there is a possible obligation. If there is a possible obligation, it means contingent liability. Possible obligation can't be provision, or a present obligation that may but probably will not require an outflow of resources. Then in that case, provision will not be required. Disclosure will be required for contingent liability. Third situation, there is a possible obligation or a present obligation where the likelihood of an outflow of resources is remote. What is the meaning of remote? There is almost zero probability that you may be required to make the payment. There is almost a zero probability. Zero probability of payment. Because you know that there is somebody who's going to take care of this entire liability. In that case, do you need to even disclose it? The standard says if the probability of outflow of resources is remote, that is no chance, then in this extreme case, no disclosure is also required. However, many companies, they do give some disclosure in the last scenario also. Okay. Do you want to go through this flowchart also? Or you'll study on your own? We will study on our own? No. After my past experience, first we will see whether there is past experience, past event. Past event is common for both present provision and contingent liability. If there is no past event, no, directly you come to this, ignore. This chapter is applicable only for past events, not for future event. Yes. Then ask this question. Present obligation? No. Possible obligation? That also no. Ignore. But if the possible obligation is yes, is the outflow remote possibility? Yes. Ignore. Outflow remote possibility is no. Then contingent liability. Okay. Come back to this point where we had moved this side. Now, if there is a present obligation, next question is outflow of resources is yes. If the outflow of resources is yes, then where we will go? Reliable estimate of outflow. That is also yes. Then provision. If outflow of resources is no, then we will go to contingent liability. If reliable estimate cannot be made, then also we'll go to contingent liability. Is it right? Hope you have understood. This was the diagram they have given earlier also in intermediate syllabus. Now we'll come to contingent asset. Exactly opposite of contingent liability. You are fighting a court case and you are expecting to win the court case. So will you recognize that possible winning amount before winning the case? No, then it is a contingent asset. So contingent asset is a possible asset. That means the probability of inflow is less than 50%. That arises from past event, existence of which will be confirmed only by occurrence, non-occurrence of one or more uncertain future event, not wholly within the control of the enterprise. So which word only they have changed? Only one word, possible asset. This was obligation. In this definition, it is asset. What is the treatment of contingent asset? Are contingent asset recognized? Disclosed? Yes. Contingent asset should not be recognized. Don't pass the entry. Receivable account debit to P&L account. Okay, being amount receivable from the other party against court case. Wait, have patience, show prudence. Only disclose in the notes. This standard allows disclosure of contingent assets. In some countries, they don't allow disclosure of contingent asset, like accounting standards issued by ICAI. Okay, the Institute of Chartered Accountants of India has issued accounting standard. There is a similar standard AS 29 which does not allow you to even disclose the contingent asset. Like contingent liability, contingent assets are also continually assessed. What is continually assessed? Every reporting date, see the status, whether it is still a contingent asset or it has become an actual asset or none. Remove it from the disclosures. When will contingent asset be recognized? If it becomes virtually certain. Virtually certain means absolutely certain, no doubt. 100% probability. You have won the court case. You have got the court degree. So the other party is willing to pay the amount. He is not going to appeal in the higher court of jurisdiction. Okay. Then welcome. Recognize contingent asset. Because it is no longer contingent. It becomes virtually certain that economic benefit will arise. The asset and the related income will be recognized in financial statement. So then you will pass the entry asset account debit to P&L account. Disclosure requirement. What are the disclosure requirement relating to contingent asset? Where an inflow of economic benefit is probable, an entity shall disclose only probable, only disclosure, brief description of the nature of the contingent asset at the end of the reporting period. You will not write an elaborate essay on that so as to attract the investor that yes, we are going to win 200 crore rupees in court case. Okay, only brief description, and where practicable, an estimate of their financial effect. It is important that disclosure of contingent asset avoid giving misleading indication of the likelihood of the income arising. So you have to draft your note very carefully. You should not give a misleading impression that we are going to earn some amount in the coming year because there is a potential asset, contingent asset. So this completes about contingent asset. It's only a disclosure item, no accounting treatment. Next is restructuring. They have added one more paragraph in this standard called provision for restructuring. Provision for restructuring means if a company undergoes restructuring due to some reason, due to change in the law, due to a court order, then they might have to incur some obligation, and for that you have to make provision for restructuring. Okay, so I think it is just similar to provision. They could have simply avoided this particular paragraph also. They should have written use all the principles of provisions. So if it meets the definition of provision, make provision for restructuring. And again, for calculating the amount of provision, you follow the principles given in the provision. But since it is given, we will go through it. What do you mean by restructuring? Restructuring means a program that is planned and controlled by the management and materially changes. So first it has to be a properly planned action of the management. If I sell this AC tomorrow, is it restructuring? No. A program that is planned and controlled by the management and it materially changes. Materially means significantly changes. Either the scope of the business undertaken or the manner in which the business is conducted. What is the meaning of scope of business? Restructuring may change the scope of business. For example, a company was manufacturing chemical. So the machine they were using were very outdated. They were causing pollution. So the Supreme Court gave an order that you have to close down because this company was situated in Agra, very close to Taj Mahal. Okay, so what will happen if this company is allowed to function for a long time? It may cause damage to Taj Mahal. So therefore you have to change your scope of operation. So now what they do? They make handicraft item. small Taj Mahal statues, okay, whatever you call that, and they sell that only. So is it a change in the scope of business? Or it can be the manner in which the business is conducted. So manner in which business is conducted, for example, earlier you had branch network. Now you have closed down the branches and you have gone into online sale activity. So this is called the manner in which the business, I am selling the same product, but instead of selling it through several branches which involve huge fixed cost, the company may go for online sale. Is it right? You receive the order, sell the product, so you don't have to incur elaborate expenses in running the business. This is just an example. Some more examples are printed in your notes which will fall under restructuring. Sale or termination of a line of business. In the previous example, this chemical company might even sell this business or terminate that activity only because Supreme Court has ordered. The closure of business locations in a country or region or the relocation of business activity from one country or region to another. So companies in India may move to China. Example. Why? Cost effective, less regulation, more freedom to work. So that will also come under restructuring. Change in management structure also. Example, eliminating a layer of management. Fundamental reorganizations that have a material effect on the nature and focus of the entity's operations. These are only examples of restructuring. This line is only important. Should you make provision for restructuring? The standard says yes. If general criteria for provision discussed earlier are met. What are the general criteria? 4 conditions. 1. There must be present obligation. Then, arising out of past event. Outflow of resources embodying economic benefit is required to settle the obligation, and a reliable estimate can be made. If the same 4 conditions are fulfilled for provision for restructuring cost, then you can make provision for restructuring cost also. Only what is the extra thing that you should know? Provision for restructuring cost should include. What will you include in the provision for restructuring cost? Because the company undergoes restructuring, there are a lot of costs they incur. Every cost is not a provision. Only direct expenditure arising from restructuring and not associated with the ongoing activity of the enterprise. Some examples are printed below. We'll come to that. Provision for restructuring is made when there is a constructive obligation. Now, what do you mean by constructive obligation? Suppose a company makes a detailed formal plan of restructuring. Detailed formal plan. Makes announcement of that plan to the public. So what will happen? It will create a valid expectation. What is valid expectation? That means people can expect, yes, this plan will be executed and this will be the outcome of this plan. Then that is called constructive obligation. When it creates a valid expectation that the plan will be carried out. Evidence that entity has started to implement a restructuring plan would be provided. Now, how do you know whether the entity is committed to a plan? By dismantling plant or selling asset or by the public announcement of the main feature of the plan. So this is constructive obligation, which shows the entity is committed for the plan now. Now there is a paragraph below, provision for restructuring cost should include and should not include. First, I will read from your note what it will include. Only direct expenditure arising from restructuring and should not be associated with the ongoing activity of the enterprise. And what it should not include, retraining or relocating the continuing staff. This is not to be provided for. And then you will not make provision for marketing You will not make provision for investment in new system and distribution network. These are capital expenditure. Don't make provision for this. There is no obligation here. You can always avoid this expenditure. Is it right? Now we'll solve one question. Chapter is over. Search for this question. X Packaging Limited 41. X Packaging Limited has two segments, packaging division and paper division. In March 20X1, the board of directors approved and announced a formal plan to sell the paper division in June 2011. So they are trying to terminate this activity, sell this activity. So it will fit into the definition of restructuring. First, it should be fit into the meaning of restructuring and then whether provision is required. Operating loss of the paper division are estimated to be approximately 50 lakh during the period from 1st April 20X1 to the expected date of disposal. Are you going to make provision for future expected losses? No. Anything relating to future, we will not make provision for that. Future expected losses are also not provided in the books. Management of X Packaging Limited wants to include the future operating loss in the provision for restructuring in the financial statement. Can X Packaging Limited include this operating loss in a provision for restructuring? The answer is why? Because it is related to future event. Provisions are made for past event. Standards state that provisions should not be made for future operating losses. Since IAS 37 prohibits the recognition of future operating losses, so X Packaging Limited should not include these future operating losses in the provision for restructuring, even though these losses relate to the disposal group. Okay, one more we will try. 43. X Cements Limited has 3 manufacturing units situated in 3 different states of India. The board of directors in their meeting held on 10th January 20X1 decided to close down its operation in one particular state on account of the environmental reasons. A detailed formal plan for shutting down the above unit was also formalized and agreed by the board in that meeting, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred. Date of implementation of the plan has been mentioned. So this is called detailed formal plan, which they have done. Meetings are also held with customer, supplier, workers to communicate the feature of the formal plan to close down the operations in the said state, and representative of all interested parties were present in those meetings. Question is very simple. Do the action of the board create a constructive obligation that needs a provision for restructuring? So the answer is yes. Because board has created a valid expectation in the minds of these people who are going to be affected by the restructuring. In IAS 37, conditions are there should be a detailed formal plan of restructuring, which should have raised a valid expectation in the minds of those affected that the entity would carry out the restructuring by announcing the main feature of its plan to restructure. So after writing the provision, then you compare the question and the provision of the standard. The board did discuss and formalize a formal plan of winding up the operation in the above said state. The plan was communicated to the parties affected and created a valid expectation in the minds that X Limited would go ahead with its plan to close down operations in that state. So therefore, there is a constructive obligation that needs to be provided. Okay, one more question. X Telecom Limited has income tax litigation pending before question 40 pending before appellate authorities. Legal advisor's opinion is that X Telecom Limited would lose the case and estimated that liability of rupees 1 crore may arise in 2 years. The liability is recognized on discounted basis. The discount rate at which the liability has been discounted is 10%, and it is assumed that the discount rate does not change over the period of 2 years. How should X Limited calculate the amount of borrowing cost? Can provision be discounted under this standard? Yes, if the effect of time value of money is significant. 1 crore rupees you will pay after 2 years. So first you take your calculator, 1 crore divide by 1.10 equal to how much you are getting? 8264462. That is the amount of provision you are going to make in the first year at the beginning, and then you have to unwind the discount. You have to calculate interest on that amount at 10% on the opening balance. So first year you will provide for interest of 10% of 82,70,000, which comes to approximately how much? 8,27,000. Then your balance will change in the next year. Again in the next year you will calculate the interest on the revised balance. So it will go to approximately 90,90,000. 10% of that, 9,10,000 approximately. This is what you will have to provide for. Okay. So all varieties of questions they can ask. Now check for this question. X solar power 37. X solar power. A power company has present obligation to dismantle its plant after 35 years of useful life. So this question is connected to IAS 16 also. X Solar Power Limited cannot cancel this obligation or transfer to third party. X Solar Limited has estimated the total cost of dismantling will be 50 lakh. The present value of which is rupees 30 lakh. Based on the facts and circumstances, X Solar Power Limited considered the risk factor of 5%. That is the risk that the actual outflows would be more than expected present value. How would X Solar Power Limited account for the obligation? So while making estimation of provision, one should also take into account the risk and uncertainty. So therefore what they will do, 30 lakh they have already calculated, plus a further risk adjustment of 5%, 1,50,000. So they can recognize a provision of 31,50,000. That is, their estimate can change by 5%. Okay, one more question. X Metals Limited 42 had entered into a non-cancelable contract with Y Limited to purchase 10,000 unit of raw material at rupees 50 per unit at a contract price of rupees 5 lakh. As per the terms of the contract, X Metals Limited would have to pay 60,000 rupees to exit the said contract. What is the contract? you will purchase 10,000 unit at 50 rupees for 5 lakh. In case if you want to cancel the contract, you have to pay 60,000 rupees. That is the cost of exiting. X Metals Limited has discontinued manufacturing the product that would use the said raw material. For that, X Metal Limited has identified a third party to whom it can sell the said raw material at rupees 45 per unit. How should X Metal Limited account for this transaction in the books of account in respect of the above contract? Now, in this example, the contract has become onerous. Such contracts are called onerous contract. You will pay 50 rupees and you are going to sell it for 45 rupees. So, how much is your loss if you complete this entire transaction? 50,000 rupees. If you want to exit from this contract, you have to pay 60,000 rupees. So what would you prefer? Loss of 50,000. You will buy it at 50, sell it at 45. So 50,000 loss you will suffer on this contract. Okay. So therefore a provision should be made for the onerous element of rupees 50,000 being the lower of the cost of fulfilling the contract and the penal cost of cancellation of rupees 60,000. Is it right? Yes. This chapter is over.